And it's a very, very simple setup. Now, let's talk about the bullish engulfing. I'm going to talk about the bearish one as well. The definition is very simple. Price sweeps the prior candle bar low. So we have a candle here. Price sweeps that candle. Then we close above the prior candle's opening price. Now, if this candle, let's just say assume this candle had like a big wick up here, right? And this candle closed below that wick, it's fine. As long as it closes above the candle's opening price and it sweeps the prior candle's low. That's all the requirements needed for a bullish engulfing. Inversely, the bearish engulfing is the same exact thing, but in reverse. Price sweeps the prior bar's candle's high, and it closes below the prior candle's opening price. Notice, it does not need to close below the low. As long as it closes below the opening price, that is validated, as long as the price also sweeps the prior candle's high. Now, this will give you directional bias for the next candle or few candles. And what do I mean by this? Let's take a look at a few examples of this in play. Right here, we have the bearish engulfing play. Look how the price takes out the prior bar's high. We have a drop lower, and price has a closure below the prior bar's opening price. So let's see what happens on the next few candles. As we see right here, this next candle had an open. We rallied up a little bit higher. We dropped lower. We even form another engulfing bar right here. Why is this an engulfing bar? Price has an open. We run up, take out the prior candle's high, and we close below the prior candle's opening price. Even if this is a bearish candle, does not matter, as long as we close below the opening price. So this candle opened up here and we closed here. So the opening price is delineated there, and we still close below. We close below pretty much the opening and the closing price, but right here, this would constitute, and we have a momentum shift lower. This right here is extremely powerful because it gives us the direction. Now, we're going to talk about time frames in the later section, but just to kind of talk about it real brief in here. If this was a daily chart, could you not find an opportunity to sell on this candle right there, looking for even a small move? Could you not look also for the same thing here? When we form this bearish engulfing, the next candle, couldn't we look for an open price to rally up into some sort of key level and then drop lower? Right? We have a fair value gap there that could be used as a target, or an order block that can be used as an objective as well. This is how I want people to think. Now, we'll talk about the time frames in a little bit, but right now I just want to show you and illustrate the concept. This will typically give you the direction for the next one candle or for the next few candles. Now, here's a good example on the bullish engulfing. Price sweeps the prior bar low. We have a close above the prior bar's opening price. Now, let's see what happens in the next few slides. Price has an open, has a drop lower into this order block. And this is what I like about this as well, because it typically will create some sort of order block. And then price essentially had a move higher. Now, again, if this was a daily chart, if this is a weekly chart, this right here would be a couple 50 to 100 pips, depending on the pair or the asset class, because again, this works on every single asset. Now, price then goes into consolidation, and then we finally have that move higher. So if we were anticipating price to sweep this liquidity pool up and there, this could give us a potential entry. We hold through the consolidation, and then price starts to have an expansion move higher. The engulfing bar will typically form at the high or low of a turning point. Now, let's go ahead and let's take a look at a few more examples so we can kind of drill this in our head. Here's another example of a bearish engulfing. Price has a rally up. We sweep the prior bar's high, and we have a closure. So now what are we anticipating? We're anticipating for the next candle or the next few candles to be bearish. So right here, price has a candle that just kind of an inside bar, meaning this candle's range is inside of this overall candle. We actually form a fair value gap, and this is why I like this one as well, which is actually an EBP3 play, but that's a different discussion. Price then comes back up in here, and what do we have? Price hits this fair value gap, and we send price lower. So again, this bearish engulfing set the stage for us to anticipate this bearish momentum lower. It's funny because, again, we have another bearish engulfing right here. Next candle ends up having a little bit of a retracement and then drop lower. So you guys can see, and once you guys go on your charts and back tests, I guarantee you will see this on all different time frames, and you will never look at the market the same, because you will see how effective this can be. If you look for any big move in the marketplace, more than likely you will see this price signature is prevalent in big market moves. Here's one more example. Again, price takes out the prior bar's high, and then we have a closure below the prior bar's opening price. And again, this now sends price lower. So now what do we know? The next candle open, rallies up, drops lower. Open, high, low, close. And now we're starting the shift into bearish momentum. Now again, notice how we have this bearish engulfing that forms right before a big price move. But now let's go ahead and let's take it up a notch, shall we? The same type of concept that we hear. When you see multiple engulfing bar plays in a row in the same direction, what does this tell us? This is essentially telling us that there's a big move potentially happening. So if you see, like, let's just say you see two bullish engulfings back to back. This one was three. So this one was like a supernova type of move. What happens is now you're getting the indication that the market is dropping lower, but it's failing to push lower. Not only is it failing to push lower, but we're also doing something which I'm going to talk about in a few, which is we're grabbing liquidity. So let's go ahead and see what happens once we have this price signature. Right here, we have three engulfing bars, and then we have price finally shift higher. And this was on some news event. I remember I took this trade. I got in long somewhere around here, and this was on a 4-hour time frame. Again, we will speak about time frames, but again, guys, this is what I mean. When you see this in the charts, you will see how there's explosive moves. I'm not here for those nice 5 to 10 moves, 15 pips that people talk about when scalping. I'm looking for the big supernova type plays and then using risk to reward to really optimize that. Now again, why does this work so well? And the secret is so simple. Liquidity. The market needs fuel to go from one level to the next. If you've looked at any big price move, whether you see the engulfing bar play or you see a different type of setup, you will typically see that the market has some sort of run on stops before a big market move. So when you take this idea, you now understand why there's a big significance in the engulfing bar play. Because when it takes out the prior bar candles high or low, especially if it's on a daily or weekly time frame, we are sweeping a liquidity pool at the marketplace. Runs and stops, they give us clarity on where the market will move. If the market is consistently taking liquidity from the downside, we understand the market is potentially accumulating long positions, so this gives us an edge. This is where an edge comes from. Where is smart money and the big players taking liquidity, and where are they accumulating positions? Now, I could have a whole separate discussion on liquidity, but again, I'm going to be focusing on just the engulfing bar plays in this presentation. Now, most of you are probably thinking, which time frames can I use this on? The truth of the matter is this. We can do this on any time frame. However, these are my three go-to: the weekly time frame, the daily time frame, and the 4-hour. But again, you can use this on the M5. I've had someone who uses this consistently on the M15, H1. You do have to have a little bit more context to use those time frames, and I talk about those all in the academy. But again, it's very easy to use them on the weekly, daily, and 4-hour. If you have multiple assets that you're watching, like you're watching EU, you're watching gold, you're watching NQ, you're watching BTC, you will have a plethora of setups if you focus on these three time frames. Now, why do I like them? Because they give you more bang for your buck. Because they allow you to work with a sizable range on the lower time frames. Because think about it, if you have a daily bar, going back to this slide, if this is a daily candle, price took out the prior day's high and we had a closure below, so we have displacement. So for me to anticipate a price move maybe down to here on gold, this could be literally, like 100 pips plus 200 pips depending on the size of the range. So for me, if I'm trying to catch this on a daily time frame or a weekly time frame, I get way bigger moves. Even this one daily candle that had a bearish move lower, this gives me potential range to trade within, especially if I could time this move on the lower time frame, which I use separate strategies for. Now, this is the part where you guys need to listen very carefully. Anyone can implement the system. I'm a very big believer in it because it requires little to no effort to identify the bar, and then you can reverse engineer the analysis. So I have a bunch of other different concepts and variables that I like to trade within, but you can look for the engulfing bar and see if it matches everything else. You don't have to have this top-down analysis approach anymore. You can wait for the bar to form and then reverse engineer.